All right, welcome back to halftime. It was billed as one of college basketball's great upsets. The Baylor men's basketball team crushing previously unbeaten Gonzaga to win the 2021 national championship. Well, now another collegiate competition has that school near the very top of another highly prized battle, the best performing college endowment in the country. Over the past 5 years, Baylor's tiny, by comparison, $2 billion fund has regularly beaten another Goliath, the illustrious Ivy Leagues. Well, two of the endowment's managers are with us today. Dave Morehead, CIO. Renee Hanna, Managing Director, handles the private investments. Welcome. It's great to have you guys on halftime.
Thank you. We're happy to be here.
Yeah, so I guess my first question, so what? You beat all the Ivy League schools the past 3 years. You've beaten all the Ivies except for Brown over the past 5. So I think the obvious question first, Dave, to you is, how'd you do it?
Well, first of all, I mean, we should say that this is a little bit of a fun competition that we have amongst all of the schools. Obviously, every school has different risk preferences, tolerances, different needs. I would say one of the things that we really try to take care of is our liquidity. It's obviously been a topic of a fair bit of concern over the last 18, 20 months or so. But our view is if we think about what our liquidity is or what our needs are in advance, then we have the opportunity to take advantage of market dislocations or opportunities as they arise. So I would say really, I think the bit that we try to get right is the cash flow and the liquidity needs that our portfolio has.
So, Dave, it's you, Renee, and 3 other ladies. Is that correct? So it's 5 total people running the endowment?
That's correct. We have 2 others that help with legal, ops, strategy, but yes, on the investment team, it's the 5 of us.
So, and what would you say is your main strategy? Now, you're not actually picking the stocks. You're looking at broader themes and then bringing the ideas to managers? How's that work?
Correct. So most endowments actually outsource the actual trading, the actual portfolio management. If you think about it from a kind of intellectual perspective, it'd be really hard for somebody to have all the smartest people, all the best ideas in one room. And so whether it's Yale or us or the schools up and down the street, almost all endowments outsource most of the investment activity. How it works from an overall perspective and the opportunities that we do take, it's really driven by the managers. And then if we on the edges are seeing something that, there's a dislocation, we could allocate more money into high yield. We could allocate more money into EM, something like that. But that's really what we're doing. We're really allocators.
So, Renee, what I find really interesting, too, is private investments make up half of the endowment. What kinds of themes are you looking at in that arena?
Yeah, Scott, we don't try to invest in all things. So we run a really focused portfolio and are leaning into sectors where we see long-term growth. So the sectors that we like today, we're leaning into technology, we're leaning into healthcare, we're leaning into consumer. That makes up roughly 80% of the portfolio. The balance is going to be more opportunistic. An example of this is when we leaned into private oil and gas investments in 2020 via secondary trade when WTI was roughly $30 and the asset class was incredibly out of favor.
You also aim to cash out before these companies actually IPO. Tell me about that.
Sure. So, we like to stay involved in companies when their revenue is 0 to 50 million, and we do this so that there's multiple paths to liquidity. If you look at the private equity industry, roughly 2/3 of capital raise is going to be in funds that are $3 billion or greater. So we try to sell into that. Our portfolio is comprised of companies that can sell to strategics or larger financial sponsors, and that multiple paths of liquidity gives us an opportunity to get the capital back into the hands of the marketable side, so Dave can be tactical when an opportunity presents itself.
Jenny Harrington, who's on the desk, has a question for you guys. I'm going to turn it over to her, and then we'll turn it to Steve Weiss. Jenny?
Hi, guys. Congratulations on the amazing performance, and love the heavy women dominance of your group. So one of the things that really strikes me in listening to you and looking at it is that you said there's 5 people who run it, and it's only $2 billion. And when I think about Harvard and Yale with their $50 billion endowments, I wonder how much size of both the committee as well as the endowment allows you to be more nimble, to move more fastly between different areas. So I'd love you to speak to that if you can.
Yeah, Dave, do you want to hit that?
Yeah, sure. I think some of it has to do with my background. My background prior 20 years was on the for-profit investment side, so I'm comfortable in this role. I'm comfortable wearing the risk. To give you some perspective, we've kind of looked back, and there's usually like one theme a year that's kind of helped or driven performance, particularly on the marketable side. In 2016, it was high yield energy. In 2017, 2018, you guys will remember, VIX was at all-time lows, so we were actually buying long vol. 2019, we were having trouble finding things to do, and so we actually built cash. 2020, post the pandemic, it was a reopening trade. 2021, we were finding difficult things. We were having difficulty finding things to do, so we went back to long vol again. Last year, we were really building a small cap position, so that hasn't particularly played out yet. But the benefit that we have is we own our own capital, so we don't have to hold ourselves to account, every 2 weeks, every 2 months. We tend to look out maybe 3 years-ish in terms of what we're trying to achieve in terms of returns versus the dislocation that we're seeing today.
Interesting. Steve Weiss?
Yeah, a question on the private side. So are you expressing your views in private through direct investing to companies, co-investments, or going with managers? And if managers, are you tending to pick the medium-sized managers because they can generally generate better alpha?
So everything we do is going to be through managers on the private side, and we are selecting managers that are smaller and can take advantage of the capital that sits above them. So typically when we onboard a GP into our portfolio, it's going to be somebody who's sub $1 billion and preferably sub $500 million.
Hey, Dave, you look at these stocks that are just like NVIDIA and all the mega caps. I'm curious, the size, the kind of exposure you have to those. You call the managers, say like, do we have enough NVIDIA? I mean, you see the stock going up just the way it has. It's pretty remarkable.
Yeah, we actually don't have very much exposure. Like I said, endowments in general are like very diverse, like way more diverse than the S&P 500. We own everything under the sun, both in the public markets and in the private markets. So what we're doing is really at the edges. Like I said, we've focused over the last year on sort of the historical spread between large caps and small caps. Since we tend to be value conscious, we've allocated more to small caps. We don't have that much exposure to the Magnificent Seven, really.
Interesting. Well, continued success. Wish you both great luck moving forward. It's exciting for your school, and it's great for us to have you as well. We'll see you soon, I hope.
Yep. Thank you very much.
All right, guys, you be well. It's David Morehead and Renee Hanna from Baylor University.